Hello and welcome to Bank Bites, a series of short videos from Kinetic Training regarding key risks to the banking sector. I was interested to read in the FT the other day an article about mortgage spreads. And in it they were claiming that mortgage spreads are very high at the moment, and the reason for this is because of the lack of competition in the UK banking sector. Well, it's one of my bugbears with finance, and it's particularly true just now as we're coming out of the credit crunch, that quite often regulators and politicians, and indeed journalists, will say things that sound very plausible, but actually don't stand up to scrutiny. My particular favourite is the assertion that if head bankers had more of their compensation tied up in long-term shares of the company, then all of this horrible business never would have happened. Well, I can only point you to Lehman Brothers, where Dick Fuld, the CEO there, had over $1 billion tied up in long-term shares of the company. I'm afraid that didn't seem to help very much, so I'm not too sure about that one. But let's investigate this assertion that mortgage spreads are very wide because of the lack of competition. So, first thing to check, are mortgage spreads very wide? Well, here we have a graph of the mortgage spreads. Just to explain what this means, the mortgage spread is a difference between the mortgage rate and base rates. So while the mortgage rates may be relatively low at the moment, the difference between the mortgage rate and base rates is rather high. And you can see that from the graph, that normally, for most of the time between 1995 and 2008 or so, the difference between the mortgage rate and base rates was around about 150 to 200 basis points, and that just means 1.5 to 2%. But lo and behold, over the last year or two, they have shot up to over 350 basis points, or 3 to 3.5%. So they're certainly correct that mortgage spreads are indeed very wide, but is this really due to lack of competition in the sector? Well, to understand it a bit better, you have to look at things from an asset-liability viewpoint. And asset-liability management, it's an area I've been working in for many years now, is about looking at the risks at the total balance sheet level rather than just in one area. So here we're just looking at the mortgage book, but what we really want to do is have a look at the total balance sheet. So let's go to an example of a very, very simple bank. I don't imagine the regulators would be particularly happy with this bank, but it will do for our purposes. On the asset side, you've just lent money for mortgages, and on the liability side, you've borrowed money from depositors. So in order to work out what's going on at the total level of my balance sheet, I need to look at the mortgages, as we have just done, but also the deposits. So here I show a graph of not just the mortgage spread, but also the deposit spread. If you look back at the bank balance sheet for a moment, there are two ways that the bank can make money. First of all, they can charge their lenders base rate plus some spread on the mortgages, but also they pay their depositors base rate minus a spread. In that way, they generate two lots of spread, one from the deposits and one from the mortgages. And if we have a look at how that has moved, the red line is the graph we've seen before for the mortgage spread, but the blue line is the graph for the deposit spreads. And you'll see that what's happened is that while indeed the banks have raised their mortgage spreads and thereby making more money on the mortgage side, the deposit spreads have absolutely collapsed, and thereby they're making a lot less money on the deposit side. So in total, banks aren't making any more money at all. It's just it's shifted from the deposit side to the mortgage side. And the obvious question is, why has this happened? Well, if we look at deposit spreads versus base rates, then we begin to get an idea of what's going on. That for many, many years, deposit spreads were around about this 300 basis points or 3% level, and they have only collapsed recently as base rates have also collapsed. And when you think about it, it's quite logical. If base rates are at 5%, I can pay you 3% on your deposits, and thereby I've made 2% difference. But if base rates are at 0.5%, as they are at the moment, I can't very well charge you minus 1.5%, then I'd be charging you for having your bank account. I don't imagine anyone would be very happy about that. And so I'm very much restricted on how much money I can make from a deposit side. And because the banks have been so constricted with what they can make on the deposit side, they've had to increase their mortgage spreads in order to make back some of that money on the mortgage side. So Financial Times was partly right. Spreads are very wide for mortgages, but not for the right reason. A word of caution. You'll now see lots of things in the financial papers about how interest rates are very low at the moment, but they can't stay low forever, they're bound to move up soon, etc., etc. Well, here's a little graph of some interest rates from 1990 to 1998, and guess what happened next? Yep, they've stayed incredibly low. Okay, Japan's a special case, and I'm not saying things are going to be this bad in the UK, but it does highlight the fact that in finance, anything can happen. Well, I hope you've enjoyed this short video and found it useful. Please feel free to join us at our website www.kinetictraining.co.uk. Goodbye for now.